talk about the wildfires in California. I know a lot of people have talked about this from the human angle, but I want to talk about specifically the insurance implications. Any big event like a fire or a tornado where you have a really large peril, insurance companies have to reflect this cost back onto premium payers. This is present in all the markets that you can see a high peril. You also have a mechanism where when that event happens too frequently, the insurance companies just get out of the market. That's a common way to also approach the high risk, drop coverage, because no matter how much you charge premium, it just doesn't cover the cost of the peril. So you have, in this case of, let's say, wildfires in California, insurance companies already leaving the state and dropping coverage for wildfire damage. So this was as recently as 2023 and 2024, and over the course of the past 5 years, State Farm and other insurance companies were dropping coverage across Californian homes. So what you can do is have regulation in place and the government step in. And a lot of times what they try to do is control the insurance companies themselves as a means of addressing this problem. They can do so by, let's say, putting moratoriums on cancellations and dropping policies, which extends the period of time the coverage is in place for people. That's a band-aid approach. Or what you can do is regulate whether the policy must include fire coverage. And again, that will cost more. So you could come in with price controls and not allow certain increases to take place and say you have to justify it. Well, the insurance companies would probably be able to justify it. Nonetheless, you'll have the price go up. Ultimately, the question is whether you can do really anything to address this problem, and I'll get back to that. But something that also is really important to keep in mind is a mechanism the governments use to deal with this high-risk situations across different states and countries that is more common. This is known as the market of last resort. In Canada, we have something like this in the form of facility association, where if you, for example, can't get auto insurance because you're considered really high risk and no insurer wants to write you, you can go to the facility association and get insurance, albeit at a much higher premium. Similarly, in California, we have FAIR. FAIR was put in place in order for the homeowners that can't get fire insurance because the prices are really high or because insurance companies are exiting the market to get insurance, albeit at a higher premium. Now, this could work, and it does in many cases. The mechanism, though, isn't necessarily equipped to deal with really high losses regardless of high premiums, which is the case here, where you have no matter how much you charge them, it just isn't enough to cover the cost of these losses. So you have a delinquent fare or last market of resort. And what happens is the insurance companies that are part of that market must now pay up into that fare in order to cover everyone's losses proportional to their market share. And that again ends up finding its way back onto your premiums because the insurance companies have to be able to turn a profit, otherwise they wouldn't be companies. So what we have is a mechanism that is meant to catch those who can't get insurance and fall through, and they're really high risk, end up in this pool called the market of last resort, which is then controlled and paid for by an association of every insurance company that is in that market together, proportional to how much market share they have. And then that mechanism tries to price the risk higher than the rest of the market as the last resort, but try to essentially stay liquid and or solvent, and in many cases it can't. So really the question is, how do you fix this problem? And I would contend that one thing you would much be better off focusing your attention on as the government would be to reduce the risk itself. Because if you have lower risk for fires, then you will have lower losses, and therefore you will have lower premiums too. So really the insurance market is the mechanism, not the thing you want to control. The thing you want to control is losses. It's the actual fire. If you do better fire management, put in regulation around where houses could be built or what kind of materials they would be used in building those houses, whatever would make the home safer and the neighborhood less likely to be set on fire, will also have the downstream effect of lower premiums for everybody. So I'd love to know what you think. There's a little bit of information about last market or resort, and want to know what your take is on this matter too. Thanks again for watching.